my name is Jack, and this is Driven Snow. This is my first video, but basically I'm going to be breaking down ETFs and other stuff. And for the first one, we will be going down to check out this stock, Schwab International Dividend ETF, Equity ETF. Oh my god. Ticker symbol was SCHY, and in this video, we'll be discussing the main ideas behind the ETF and help you decide if this asset is worth adding to your portfolio. For some people, this might not be. This is a stock you should really be investing in to counterweight if you have too much United States and you need something else. So in this, we'll be going over the four main topics, the rules, the other stuff, and the four topics would be: what is SCHY, what are the index eligibility rules, which is like the rules that you have to follow or that the ETF follows for it to be included, what are some of the index construction limits, so some of the limits on minimum market cap and stuff like that kind of plays also into rules. And the last thing that we'll be going over is some of the other operational rules that aren't main rules but are like the amount per sector and stuff like that. Throughout the video, I'll also be showcasing all the data points and examples on how these rules work in practice. What is SCHY? SCHY is often considered the international brother of SCHD. They follow very similar guidelines, but SCHY focuses strictly on non-US stocks, whereas SCHD focuses only on US stocks. The main goal of this ETF is to provide a steady dividend income and long-term growth and low management fees. Now, the main goal behind SCHY is kind of to pair it with SCHD in most cases so that you will have an international background and a US consolidated background, because most people who own SHD want a little bit of international. And we'll be going over the index and eligibility rules. For the first rule, it's widely considered, or what I would consider, the benchmark. SCHY tracks the Dow Jones International Dividend 100 Index. This means only stocks that qualify for this specific index are eligible, filtering out all the small cap ETFs and all the unproven and other stocks that would not make it. And the second rule is the non-US companies only. So specifically, like what I was talking about earlier, is you can only invest in this if it's non-US. Now this can be EU, Britain, Japan, India, Canada, anything that excludes the United States is in this, as long as they feature all the other guidelines. Companies must have roughly 10 years of consecutive dividends payments. This stabilizes the ETF, making sure that it only holds reliable dividend payers and that it distributes cash even in bad markets. Since most companies that pay for 10 years, 15 years, 20 years aren't going to suddenly cut their dividends, because they usually might have a stockpile, or they might be in such a sector where they don't have as much downturn as far as free cash flow compared to other companies. Rule 4 would be minimum market cap. Stocks must have a flow-adjusted market capitalization of at least 500 million initially, or 400 million for existing holdings to remain in the fund. So that means every once a year that they do their exchange that I'll go over later, they will take out all the companies that no longer meet the minimum requirement, and they'll replace it with all the new ones that have at least 500 million as kind of a safety barrier to get rid of all the small cap dividend holders that don't have enough liquidity or any other metrics that would fit for this rule. To further expand upon Rule 4, I'll be going over Rule 5, which is fundamental ranking. The index chooses the strongest companies based on cash flow to debt, return on equity, dividend yield, and dividend growth. It has to meet all four of these in its sector to make sure you can continue to invest, or that Schwab invests in their index. Companies with the highest overall financial strength and dividend quality will always make the cut over companies that have lower ones. And for the sixth and final rule, we'll be going over liquidity screen. The index ensures that the stocks have actively traded companies and must have enough daily volume so shares can easily be bought and sold. This is protection if they can't sell it whenever they do reconstruction or other events. It also stops them from having companies that are extremely volatile or extremely unactive and probably lower growth. This is a great barrier for the index. Next, we'll be going over the index construction limits. These are similar to the rules, but are more fundamental than the rules. So for the first rule, it would be, or the first limit, if you really want to call it that, 100 holding maximum. The index caps out at exactly 100 stocks. This keeps a portfolio focused on highest quality international dividend stocks. It also makes the manage it also makes the fund easier to manage so that we don't have to worry about higher fees or other stuff, while also making it easier for you to individually look at every stock in the ETF and track it individually if you really wanted to. Whereas something like the S&P or like any other VTI or any other big international stock where there's too many stocks to look at, you could look at the very basics of each one pretty much easily. The next index construction limit we'll be going over is weight caps. No single stock can make up more than 4% of the ETF, and no single sector can make up more than 15. This allows more diversification and reduces overall risk for investors. Now, what this helps with is not letting a stock like Nvidia or letting a sector like oil or technology have huge swings in the market affecting the entire ETF. Instead, if one goes down, one will go up, and hopefully, and as we've seen over the time, both SCHD and for the past 3 years in SCHY, uh, allowing that happen to let it grow at like 3%, 4% instead of it having huge swings all the time. The next part of the index construction limit is rebalancing and review. The holdings are rebalanced quarterly to account for market changes, which is like instead of being 4.6%, it goes all the way back down to 4%. This usually happens roughly when the dividends pay out, and the entire index is reconstituted annually every March to replace companies that no longer meet the strict criteria, like if their market cap goes down too low or if they stop paying dividends. This allows you to continue with the payment without also having reap the upsides of all the dividends. And for the fourth thing we'll be going over is the other operational rules. Expense ratio is the first one we'll be going over, which is that SCHY has a very low expense ratio of 0.08. This means that you'll be paying very minimal management fees compared to other international ETFs, maximizing your long-term growth and dividend returns. Now, this is considerably more low than the other ETF dividend payouts due to taxes on the region, and I think the 0.08 is a very good margin. Other operational we'll be going over is dividend payouts. A SCHY pays out dividends quarterly. This is typically in March, June, September, and December. While this isn't a monthly payer, it still provides really high, reliable income from the international market. So if you're looking for monthly payouts, this probably isn't the correct stock for you, which is totally understandable. Now, also, I would like to include that SCHD does the exact same schedule and pays out typically, as far as I'm aware, on the same dates. So the last thing we'll be going over, it will be the creation and redemption. Like all ETFs, SCHY trades on the open market like regular stocks. It uses creation units, large blocks of shares. It keeps the ETF market prices more in line with its underlying assets. This makes international investing much easier as you don't have to navigate foreign brokers, or if you don't have the choice to navigate foreign brokers, it provides complex uh, deals for you so you don't have to pay the taxes or you don't have to set up the individual stocks yourself, which for me, when owning something like ASML or like whatever other European one where you might have to pay taxes on it, you don't have to do that yourself. Instead, it makes a much easier way to navigate the international market. If you enjoyed this video, please leave a like and subscribe. This is my first video, and I'm just testing out the waters. Thanks.